Hey all, I hope everyone is doing well. So in this video, I am going to talk about India's largest infra deal that involves the Adani Group and the company called Holcim, that is a Switzerland-based company. So before proceeding with the video, kindly subscribe to the channel. So without any further ado, let's jump straight into the video. So what the deal is all about. First of all, we'll talk about what the deal is, which entities does it involve, how has the company paid for, well, the acquisition, and we'll also discuss some of the key highlights of the deal. So first of all, it involves, as I mentioned, the Adani Group and the Switzerland-based company called Holcim. And via this deal, Adani Group has acquired the stake of Holcim in two of the cement companies in India, that is Ambuja Cement and ACC Limited. Now, this deal is deemed to be the largest ever acquisition in the Indian infrastructure space. Recently, as of 16 September 2022, the Adani Group has paid Holcim a cash consideration of USD 6.4 billion, which was funded by pledging the acquired stake in the two cement companies, that is Ambuja and ACC. So it is quite a highly leveraged deal, I must say. Later in this video, we'll also look at how the leverage at the Adani Group has increased in the last few years. Then the open offer to acquire the public shares received a lukewarm response as the offer price was at a deep discount as compared to the prevailing market price. So what is an open offer? Open offer is made by the acquiring company to acquire the public shares of the target company. And this is usually done to give the existing public shareholders to make an exit just because there is either a change in the controlling stake or there might be a substantial acquisition of the shares. So this is the reason as to why the open offer is made. And because the open offer involved a price that was at a deep discount as compared to the prevailing market price, so the response was not as enthusiastic as the company might have expected. Moving on to the key deal highlights. Because of this deal, the company is all set to usher into the new vertical, that is the materials, metal and mining. This deal has also given a nudge to the Adani Group by providing it the coveted second position in terms of the cement manufacturing capacity in India, wherein the combined capacity of the two entities is approximately equal to 70 million tons per annum. Thirdly, the group aims to grab the opportunity of fueling the per capita consumption of cement in India, which currently stands at around 250 kg per capita. But if you look at the similar metric for China, it stands at around 1600 kg per capita. So this is where the company is aiming to fill in the gap or narrow down the gap, which is depicting an approximately 7x headroom for growth. Lastly, the group is also aggressively planning to increase the capacity of the two combined entities to approximately 140 million tons per annum in the next 5 years. Now I will talk about the post-deal shareholding of the company. So as we can see, initially Holcim held around 63.11% in Ambuja Cement and 54.53% in ACC. But now the stake has been shifted to the Adani Group, which holds a similar percentage now. Please note that the ACC stake of around 50.05% has been held by Ambuja Cement, and the rest of the 4.48% out of the 54.53% was a direct stake of Holcim, which it has also divested. Now, after having a look at the post-deal shareholding, I would like to turn to the Excel sheet for some calculations in the terms of the leverage and the valuation. So let's jump straight into the Excel now and let's see some of the numbers. So here's the Excel sheet. First of all, I will delve into the leverage part. So if we look at the Adani Enterprises Limited, which is a flagship company of the Adani Group, and I look at the consolidated financials of the company, in the last four fiscals, you can see that the debt levels have been increasing each year. Similarly, the net debt levels have reached approximately 4x levels as compared to what it was in FY19. If you look at the net debt by EBITDA, or which is also one of the leverage metrics, you can see how the chart is moving, wherein the slope of the line has increased from FY20 to 21, then 21 to 22. So there has been a sharp increase in the debt levels, as we can see here, as compared to the EBITDA, which is indicative of the fact that the company is highly leveraged. And if you see the EBITDA for FY21 and 22, there has been approximately 50% increase. But if you look at the debt level, it has increased approximately 150%. Note that these figures are as of FY22, or basically 31st March 2022. We have not taken into consideration the current pledge that the company has taken against the acquired stake in Ambuja and ACC for the transaction. So that has also added to the debt of the company. Well, that remains to be seen how the company manages the debt, but the company is highly leveraged, especially after this deal. Now, if we talk about the coverage ratio, which is the EBITDA divided by the finance costs, or in the simple layman terms, I can say how capable the company is to service its finance costs. So for that, I will divide the EBITDA by the finance costs. As you can see, these are the numbers that I get. And again, I have created a chart for the same, wherein the number is increasing till FY21, but it has come down in FY22. So till this point, it was fine, but now it has come down. Although this number is also fine, it means that EBITDA is approximately two times the interest. So this seems to be a comfortable position for the company. So here you can see the EBITDA has increased approximately 50%, but the finance costs have increased approximately 100% from FY21 till FY22, and that is mainly because of the increase in the total debt. So this is the reason as to why the interest coverage has come down in this period from FY21 to 22. But still, the company seems to be in quite a comfortable position, because the EBITDA is still at approximately 2x levels of the interest costs. So after this, we'll look at the profitability of the company in terms of the tons of cement that the company has sold. I think it would be more convenient to look at the chart here that I've created for EBITDA per ton. So this essentially means what EBITDA the company has generated per ton of the cement that the company has sold. So EBITDA is the earnings before interest, tax, depreciation, and amortization. So this is going to be available to all the investors of the company. So the EBITDA per ton for the two companies has been increasing each commercial year, starting from CY18 till CY21. So please note that for Adani Enterprises, this was FY. So this basically means a financial year, and the financial year for the most of the Indian companies is from April till March. But for the two entities here that we're talking about, Ambuja and ACC, the financial year is basically the commercial year that starts from January and ends in December. So this is the reporting period for the companies. Hence, we have taken the CY here. Please don't get confused with the notations here. All right. I hope this CY thing is clear. So as we can see, the EBITDA per ton for the two companies is increasing in all across all these commercial years, which is a good indicator, or which reflects the profitability on the two companies front. And now after this, I will talk about the valuation. So for the valuation, I have taken the EV per ton metric. For this, there are two concepts that you need to understand. First is the market capitalization, and second is the enterprise value. So just to break it up in simpler words, let's say you are considering buying a house. Well, let's say the house costs around, okay, we'll take an exact figure, let's say 1 crore. Now you infuse INR, let's say 40 lakhs. The rest of the amount is financed via mortgage, that is INR 60 lakhs. Now the equity value or the market capitalization that I have written there. So these are analogous. You can use either of these terms. So the equity value is going to be the money that you infused on your own. That is INR 40 lakhs. The enterprise value, on the other hand, is going to be the total value of the house. That is INR 1 crores. So you can say that the enterprise value is going to be the value that is available to all the investors. The equity value, on the other hand, is going to be available only to the equity investors, or basically the people who have invested in the equity or the shares of the company. But when you talk about the enterprise value, this is the value that is available to all the investors, be it the equity investor, the debt investor, or we talk about the preferred shareholders. This is how we classify equity value and the enterprise value. Now, in order to calculate the equity value, so we need two metrics. First is the share price, and second is the share count. Now, for this, I would require the share price as on 31st December 2021. So this was the share price of the company as on that date, and this is a share count as on that date in crores. Now, how do you get these values? Now, for the public companies, head to bseindia.com. Just type in Ambuja Cements. Click on Ambuja Cements Limited. So this page will appear. Click on, let's say, 1 year, and now I'll hover the cursor over this chart to find the date for which I am looking the share price. So as you can see, December 31st, 2021, the share price was 377.55, and as you can see in the formula bar, this is the value that I've written here. For the share count, what you can do is just go to the shareholding pattern here. After you click the shareholding pattern, just click on this arrow for more details. A new tab opens up, and here you can go to the archives and select December 2021. Then scroll down and look at the total number of shares held. And this is the total, the grand total. So this is the total number of shares that was held as on 31st December 2021. And this is the number that I've written here. Well, I've converted this in crores by dividing by 10 raised to power 7. So this is the value you get. That is 199. The equity value is the product of the share price into the share count. This is the value that is available to the equity investors of the company. And this is in crores of Indian rupees. Now, for the enterprise value, as I said, that this is the value that is available to all the investors of the company. So for this, you need to add the total debt, because cash is already a part of the company, that is already within the company. So we need to exclude the cash. And after these calculations, subtracting the cash and equivalents and adding the total debt, this is the value that I get. So this is the enterprise value. I have calculated for the valuation the EV per ton. So the EV per ton here denotes the enterprise value of the company per ton of the cement production capacity. Now for the production capacity, I have looked into the annual reports of the companies and I have added the values here. This is what we get, that is 20,134 Indian rupees. So this is the EV per ton for Ambuja. And after this, I have taken the USD to INR exchange rate as on 31st December 2021. And on the basis of that, I have calculated the EV per ton in the USD terms by dividing the INR value by the exchange rate. And this is the value that I get. Similarly, I have calculated the values for ACC. Just for the comparability purposes, I have taken into consideration the market leader, that is Ultratech Cement. Now, with a similar process that I just explained for Ambuja, we can look up for the share price, share count of these companies from BSE, and we can calculate their market caps. Then we can look at the annual reports of the companies for the cash and equivalents and the total debt, from where we can reach the enterprise values for these companies. And finally, we can see the cement production capacity of these companies either from the annual reports or the investor presentations. So this is how you fetch the information for the public companies free of cost. And finally, we will reach the EV per ton for all these companies. And as you can see, the EV per ton in USD terms for all these companies is calculated here. So this is the approximate price that the Adani Group has paid for these two entities. So this is one way of valuing a company wherein we have taken the enterprise values and the production capacities, and we have calculated the enterprise value in terms of the production capacities. I hope this video was useful for you guys. Hope you have understood the concept of leverage, profitability in terms of the operating metrics, and valuation in terms of the enterprise value compared with the ton of production capacity, and the concept of market capitalization and enterprise value, and also the key deal highlights of the Adani Wholesale deal. Please consider subscribing to the channel. Also, let me know in the comments if you would like me to cover any specific topic that interests you, and I will try making a video on the same. See you the next time. Thanks for watching.